session. Good evening and welcome to another session of our webinars from Cherry Street Investments. I'm Kavitha Baratakke, and today we're going to be talking about multifamily lending in the COVID world. I'm excited to have our guest speakers on. Barry Lefkowitz, sorry if I butchered your name, Barry. I hope I said that right.
Good deal.
And Mordy Geffner. Barry and Mordy are Senior VP and VP respectively at Meridian Capital. Meridian Capital is the #1 multifamily debt intermediary in the United States. In 2019, Meridian closed over $40 billion of commercial financing, spanning close to 4,000 deals across the United States. In the light of the upheaval COVID has caused, economically and otherwise, I wanted to bring on a multifamily lender to talk about what it has meant in the current environment and how multifamily lending has been affected with this current situation. Specifically in today's webinar, Barry and Mordy will cover the lending options in the multifamily space, namely agency, bridge, HUD, and balance sheet lenders. We'll talk about how each of these lenders have reacted to the COVID situation, and he'll also cover what you can expect post-COVID in the multifamily lending space. A quick disclaimer here, this is always for educational purposes. Obviously, we have lenders here, they know what they're talking about. So not much of a disclaimer here, but still for anything specific to your situation, please consult them one-on-one and get your estimates for your deals. So a few housekeeping rules. If you have any issues with the audio or visual during the presentation, please let me know ASAP in the chat box and I can fix it. I've had a lot of internet issues lately, so hopefully this stays up. And if I drop off, then I hope this webinar continues with Barry and Mordy and I'll hop back in. Please also locate the Q&A box in the Zoom application and use those to type the questions in. It's just easier to track in the Q&A box. A lot of folks have the webinar recordings going to the spam or promotions folder. So if you can please add my email, kavitha at Cherry Street, to your contact list, it'll make sure it goes to your inbox so you can actually see the recording. So I get a lot of emails about this every week. Just a quick note about some upcoming webinars. We have another webinar in June. This will be an educational one on senior living. We have speakers Vinny Chopra and Shahid Imran. Shahid is a senior living expert, and he and Vinny will be talking through this asset class and investing in this asset class and the upsides of investing in it. And if you're interested, you can register at this link, Invest Senior Living, bit.ly. In July, we also have a webinar on estate planning with Anderson Legal. We've also been doing a lot of kids' financial education. So if you're interested in it, you can look it up. It's called MoneyWise Learning, and we have a lot of recorded webinars on YouTube. We have a session next week on stocks and real estate investing. And believe it or not, our 11 to 15-year-olds are actually very interested in learning about investing. So I'm excited to have them on. And we are setting up a stock league where we'll be doing virtual trading with the kids. We also had this younger kids webinar and it's all wrapped up. Just a quick note, if you are interested in looking at the recordings, I also post that on YouTube. A lot of investor education on real estate, tax planning, lending, and a lot more. And the youth financial literacy education, everything's on YouTube. So if you'd like to follow me, you can subscribe to this channel and you'll get updated whenever I upload new videos on here. A lot of you folks know me, so I'm not going to spend a lot of time here. I have been in real estate for the past 11 years now, and I started with the single family homes and moved to the multifamily space as a syndicator. I come from a technology background. I've spent the last 20 years in IBM and then a company called Atlassian. I also work on infinity banking practices. So I work with a company called Paradigm Life. And I run a group called Purely Passive Investor Group if you want to look us up on Facebook. Our guest speakers today, Barry is a senior VP at Meridian Capital. Like I mentioned, they are a huge funding source in the United States and one of the largest funders today. Barry started his career in financing industry over 14 years ago and has really worked himself from the bottom up. He's a team leader and expert in commercial financing world. And he runs a group called Barry Group that has closed over $1 billion annually every year over the last 5 years. So they do a huge amount of volume here at Meridian. Mordy is the VP at Meridian Capital. His focus has been, personally, I've been in touch with Mordy for a while, and he's super helpful, and he's always trying to outreach and do a lot of outreach to his clients and really help them with understanding lending and guiding them through guiding his clients through the loan process. So he helps a lot of clients grow their portfolio from hundreds of units to thousands of units. And he also oversees the underwriting and the smooth financing process as people grow their portfolios. He is a member of Barry's group and has secured in financing for about $100 million in multifamily loans. He's also an expert in agency and bridge debt. With that, I'm going to hand it off to our guest speakers. Thank you so much for being here, Barry and Mordy. I really appreciate your time, and I'm excited to see what you have to share with our audience today.
Well, thank you for having us, Kavitha. Appreciate everybody getting on over here, taking some time out of your schedule. And thank you for joining us. Hopefully we'll be able to share some real knowledge during this crazy time where things are changing constantly. Things are all over the place. And, hopefully we could give you our little bit of a finger on the pulse that we have throughout, the multifamily lending world in COVID and post-COVID when things come out. And, we hope to rebound strongly. Things are already looking up, and it's an exciting time right now to be in multifamily and to get into multifamily. With that, I think I would like to bring on my partner, Barry Lefkowitz, and, sit back and enjoy, guys.
Hope you guys are all doing okay. I want to make sure everybody can see the screen. Are we all clear on the screen in front of us?
Yes. You could expand it and just hit the slideshow play. That might help.
I should expand it. Hit the
slideshow on top and just hit play.
Gotcha. Hit the slideshow.
The slideshow on the top bar.
Got it.
Yeah.
Okay. Hit the slideshow on the top bar.
And then play from beginning, the first button. Yeah, the first one. Yeah.
Say this might not be a...
There you go. Are we good now?
No, just hit the first button, Barry. First one on the leftmost of the screen. There you go. Yeah.
But now on the wrong slide. Okay.
Perfect.
Am I clear now? This one?
Yes.
Okay. Let's run into this presentation. I appreciate everybody getting on here, and anybody who wants to stop to ask any particular questions, feel free to do so. My name is Barry Lefkowitz. Like we mentioned, Managing Director of Meridian Capital. Meridian Capital is a funding shop, a debt shop. Company closed last year, $40 billion. I would say the trajectory this coming 2020 was just going to continue soaring. And obviously we all hit this COVID bump in the road, which sort of startled everyone in the world. And as a veteran in the financing business who's been around, through the last cycle back in 2008, 9, 10, and weathered the storm through the process, you sort of get an understanding as to how things need to adapt, how people need to adapt, and who ends up being the winners in the next cycle. People have been talking for the last number of years that there's sort of an expecting cycle to happen in real estate. 2011, the market started up again. 2012, 13, all great brains in the real estate industry said a normal real estate cycle happens somewhere between 5 and 10 years. And yet we have not seen a cycle happen. Real estate seemed to just be the most secure place to put your money. The stock market bounced around up and down. And real estate, every time someone bought an asset, waited 2 or 3 years, appreciation of values continue going up. And investors were able to either earn their returns based on cash returns or just simply appreciation. There was a sale at that point. Most investors got back their money plus returns. And then put the money back into next real estate venture. So with that being said, a real estate financer is somebody who not only just gives, offers debt to customers. Our job is and the responsibility on my part is really to get involved in our client's business plan, realize where they're buying and what they're buying and how they're buying it. And, from my perspective, you get to see 15 years worth of, bricks and sticks worth of worth. And at times we're challenging our customers as to why buying a certain asset based on how much the valuations are currently or where the market rents may go to and their projections. So in no way I want to misconstrue that sort of financing is sort of limited to put a piece of paper down and figure out what your rate and your terms may be. It's sort of a holistic appreciation of customers, where they've been, what they want to achieve, what's their end goal, and being myself a person has gone into the real estate through investing with my existing clients. You sort of see the cycle happening firsthand, so that you're not just financing deals, you're actually getting involved in deals yourself. So, the market obviously, March came about, everybody was sort of concerned. Right now we're over 40 million people and unemployed. Government kicked in and provided tremendous amount of stimulus. March and April's collections seem to still be on a good number. May's collections are coming in as well. Now that the month is cleaned out as well, it seems to be doing pretty well. And it's yet to see what happens once the stimulus package sort of dies down, once the people start going back to work or unemployment, codes out, where rents are going to be. Have tenants been paying with money they have in savings? Have tenants been paying with the stimulus check? And are tenants now going ahead and back to work, and now that they're paying because they have their salaries? So a lot of it's unknown. And as much as you're an expert, understand that there's an evolving aspect to this whole business at the moment right now. But, we got to freeze the moment where we are right now at the particular moment and look at ourselves and say, okay, obviously most of us on this chat here are either involved in real estate, primarily in real estate, or looking to go into real estate. Okay. Now, if you're in real estate and this is your primary job, you obviously want to continue doing real estate because that's the biggest source of income is going to come from. People that have existing portfolios have the benefits of looking at their portfolios and saying, this may not be a time to buy, but this may be a time to refinance and, take advantage of low rates and, low cap rates. People that are considering going into real estate need to look at it and say, where's that opportunity? How many people went into real estate in 2011 and 2012 when the market first started coming back and have made huge successes in the fact that they started now versus started at the height of the market? So that's just a number of things to start off with. My job here today is just to talk about financing, because that's our primary job. We are financiers. Our business is to help people, like I mentioned, find the best deals in the financing world, understand their numbers and their cash flows, and provide them the proper debt that's associated. So we put together a sort of a slideshow here to talk about a variety of different options. It doesn't necessarily cover every single option, but a majority of the options hopefully will be covered with this show. Okay, so let's talk about what changed as a starting point. Okay, what changed in the real estate in the financing assumptions? There's always been an objective look in real estate in financing as to how lenders will look at a deal and look at a set of numbers that are being provided. Basic concept is you buy a deal, the way you decide how you want to buy the reducer real estate is you're typically looking at the T12, a trailing 12-month income and expense numbers, and you're looking at a rent roll, and you're trying to make an analysis as to how the previous sponsor has ran their property and how would I like to run the property. And sometimes there's a variety of stresses that you guys would take. There are a variety of stress tests that we take. Okay. Sometimes you're more conservative than us. We have the ability to be more aggressive on some of our underwriting assumptions. Whereas the person that's actually running the real estate may have a more conservative view, knowing that, they can't live with a hiccup So they got to stress their deals a lot harder than we have. What we've seen now is that the lenders have stepped up this concept as well and said, our assumptions are going to have to change as well. The ability to stress certain deals or take assumptions on certain deals are going to change. How is that? I'll give you an example. In my backyard, we're located in New Jersey. Just forgot to mention that sort of, our physical address is New Jersey, New York, sort of the tri-state markets up in the Northeast, who, as you guys know, have been hit probably worse than anywhere up in the United States. Lenders that, that are looking at rent rolls today that are at 95, 98% rent rolls, they're saying, we're going to stress these deals to a 10 to 15% stress test on vacancy factors, knowing that although right now the tenants are in there, but evictions are held for most of us that know that our own, properties that have agency debt, with the CARE Act that was put into place, the stimulus bill, it doesn't allow tenants to do evictions for at least 120 days. So you may have a property that's 95% physical occupancy, but you can't throw out a tenant that hasn't been paying. You can't do much of an eviction. So we're no longer just taking the assumption normally that a property is at 95%, we're going to keep to a 5% vacancy factor. We're going to stress those deals to a 5 or a 10 or a 15% in certain instances, depending on where that market is. Obviously, every time they stress the deal, it puts a more of a stress on the overall NOI, which turns your objective loan request is obviously going to get tighter in that capacity. So you've seen lenders look at stress tests, expense assumptions, the ability for a buyer to come in and say, the property's been running at a certain level of payroll at $1,400, $1,500. I can come in, reduce the staff, run it now at $1,000. I can look at my R&M, my repairs and maintenance numbers, and make an assumption that I can do a better job, renegotiate service contracts, and the rights have always been a way for us to finagle higher leverage on loans, on deals that seem tight. At this time, just one of the things that the lenders are looking at, and their assumptions are changing. The most important we've seen is that service reserves. Okay, any deal today that's being closed, practically by any lender in the United States, has some sort of reserve associated to the closing. So you're closing your loan at a proceeds level, the cash flow may be there, but the lender wants an upfront reserve of up to 12 months of full debt service is the amount of money you're paying for the mortgage over a period of time. So normally you take that money out of your net cash flow. Here they want that money being put up front for 12 months, and you can't use that money necessarily to pay your debt service, to pay your mortgage. It's in addition to paying your mortgage on a monthly basis, they want an additional 12 months worth of reserves. In addition, they want an additional reserve on tax and insurance. And so, there may be maybe looking at this as being an 80% or a full leverage loan, but at the end of the day, after you figure, putting up a reserve for, debt service, putting up a reserve in tax escrows and insurance, it probably looks more like a 77, 78% cost, which, factors in the fact that you may have to raise additional capital in today's market than you may have been, willing to do, 2 or 3 months ago. So that's just on the surface. The minute the COVID hit, this is what the lenders sort of, changed. Let me go to the next slide here. And as most of you know, a lot of the larger loans that we do, and even the smaller loans with the small platforms, are pretty much tossed up between Fannie Mae and Freddie Mac. Okay, those are the two largest government issued issuance of mortgage-backed securities in the United States. They guarantee loans, and they make it very competitive for people to finance. Their agencies were established based on the fact that people need housing in the United States, and to make affordable housing, they provided multifamily investors the opportunity to have cheap rates so that they can go ahead and buy real estate and provide for the people. And as markets have been growing, aggressively, they're becoming more aggressive. They want to do a certain cap volume, but they split into how they look at certain things. They weigh their options based on risk versus reward. And when you're looking at a transaction, it's very important to note who is looking at that transaction. Is it a Fannie Mae transaction that someone's looking at? is a Freddie Mac transaction. And a lot of people have this misconception as they use a certain lending shop, they sort of understand that they have a certain way of getting deals done. But in practically speaking, in a variety of different ways, certain shops specialize in a Fannie execution better than they specialize in a Freddie execution. Certain shops, specialize in the Freddie versus the Fannie. I would tell you almost, consistently, never want to necessarily go out to one particular shop with all the options. Generally, you want to have someone approach one Fannie shop for one particular, set of eyes, and have another shop, look at a Freddie deal versus, for another set of eyes. And we've been able to win a lot of business because we understand the variety of differences between the two spectrums and who may come in more competitive. So, for example, if you went to price a deal today, Fannie Mae is pricing deals somewhere around 250 over, similar to where Freddie Mac is, but they've established a 90 basis floor on the 10-year Treasury. Now, 10-year Treasury had dropped down to 30 basis points. It's up now to about 67 basis points, but they're still instituting a 90 basis points Fannie Mae rate floor. So although you may be getting a 250 spread, but when you're comparing it to a Freddie loan, which may be at 250, Freddie only requires a 50 basis points floor rate. So automatically over there, the same spread between the two lenders may have a 40 basis points realization of a difference between, where that rate may end up being. Freddie may even be at, 260. They're still at a better spot than the Fannie deal. Although when you talk about it, it seems like, one is sort of higher spread than the other. So important to know specifically what the and who the who the shop is on the Fannie versus the Freddie to understand the floor rates. Second of all, we're seeing Fannie deals being stressed at 130 debt service coverage. Typically, we've always been used to a 125. Obviously, the lower debt service coverage ratio you have, the more dollars you can potentially take out of a deal. Fannie stressing those deals, to a higher level, obviously is going to create a stress on the deal, and the ultimate take out of your proceeds will be stressed as well. Interest only, which is obviously a big component, and real estate syndicators need in order to go ahead and to provide cash on cash returns, is interest only, and we've been successful in the last number of years to get maximum interest only on transactions. Lower leverage, we did a 15-year fixed rate loan with 15 years interest only at a 65, 70 LTV level. Today they're scaling that back, realizing that, over time we want the deal to amortize. And Fannie right now is pretty much at a, unless it's low leverage, they're trying to keep deals at 3 years interest only. Freddie has the ability to go to 4 or 5. And it's not necessarily in all instances. It's how they stress their deals on the exits. But again, there's a lot of challenge in the markets. And if you're out there shopping a deal and you're interested, you're hearing on the street that you may be only able to get a certain amount of interest only, recognize that particular shop. Maybe you're going to one of the two option lenders, and it may not necessarily be the only deal available. Now, the biggest difference.
No, just to jump in for a second on the interest-only point, right? Early in COVID, where people were worried that they wouldn't be covering their debt services, that was another important thing for us to say, hey, you might be amortizing right now, but if we could get you back to an interest-only loan, that might help you negate your fears to be able to cover debt service. So, something else to also consider in this whole, pile of air.
And then the last thing here is the reserve. So, Fannie Mae instituted a 12-month reserve. Okay, the 12-month reserve is for debt service, like we mentioned in the previous slide, but it doesn't only include 12 months of interest and principal payments. It also includes 12 months of taxes, 12 months of insurance, and 12 months of replacement reserves.
And Barry, I see a question over here just before we continue. Raul is asking a question about the different markets where Fannie is stressing some of the higher debt service coverage ratios.
Okay.
We've
question.
Yeah.
Good question. I mean, the markets right now we know that there's stresses off the bat. Houston, Oklahoma City, and parts of Louisiana, where they're very, very heavily reliant on the oil and energy industry, and we've seen that come crashing down because gas.
Orlando as well.
Orlando is a big market based on tourism, and any market that's sort of tourism based is another market that's been looked at very severely. Cash out refinances in general have been looked at as a hard as stress. So for borrowers coming to purchase a property, they certainly will get a strong bid, but when they're coming to refinance and cash out, they may be stressed at a 130 debt service coverage. Certainly we're seeing that in the Freddie SBL space, small balance loans. Everybody's familiar with those loans under $7.5 million. All those deals have been cut back, where traditionally you were able to get an 80% Freddie SBL cash out refis reduced to 75, and markets that were only getting 75 are reduced to 70, and debt service coverage is as follows as well. But to continue on my point here on Fannie versus Freddie on the debt service reserve, Freddie Mac only requires a 9-month debt service reserve, and it's only on P&L on payment and interest, P&I on payment and interest. So there's a vast difference between the amount of money the borrower may need to come to at closing to close a Fannie Mae loan. It'll include 12 months of reserves plus insurance plus taxes plus replacement reserves. On Freddie Mac, it's only 9 months. So it's an important component to recognize. If you're out there, you need to be able to take a look at both sides of the options, both sides of the spectrum. Never let your broker down the path of only showing you one side of the coin. It's very important that you let the Fannie versus the Freddie compete and see how the end result works for you. To go into our fourth slide here. Staying away from, Fannie and Freddie. There are still a number of alternative options how to get deals financed. We've done a lot of business on the credit union side. To understand, a credit union is really just a small bank that works sometimes on a national level. They certainly have a more conservative look on deals than the agencies would have. They're typically for the borrower that's looking maybe to go out of 4 or 5 years on a loan, maybe a acquisition where they believe there was upside in the deal. They may not be ready to put on 10-year debt on them, but they require partial recourse generally in order to get to get the deal sort of to 70, 75%. In circumstances, you could get a 65% deal done non-recourse, and they have bank rates. The bank rates today are about 3.75 to 4%, depending on the term of the loan, if it's a 5-year loan or a 7-year loan. But the benefits of them is that they have flexible prepayment penalties. They don't require reserves on a monthly basis, and they can be flexible about the upfront reserves when it comes to debt service. So it's a negotiable.
Just to add on to Barry's point on credit unions, there was a deal that we recently actually used them in lieu of a bridge, where somebody just wanted to take short-term debt, and we gave him pretty much full capital stack, and we were able to get him with a very flexible prepayment penalty with bank rates still, and that was a win-win on his end of things. So those are some of the times where we'll use a credit union over some of the agencies and some of the other lending options.
What kind of rates do you guys see on the agency loans? What ranges right now? Versus credit unions? What kind of rates are you seeing on the agency loans versus the credit unions?
Yeah, that's a good point. I never have the rates. I mean, I'll tell you the deals that I've gotten quoted in the last week, so you sort of understand. I got quoted today a deal. This is a little bit lower leverage, so it may not apply to most people. It's a 65% LTV deal. It is a 10-year loan with 10 years interest only, because we're at lower leverage. We have an option on yield maintenance for that loan is at 3.11% today. Okay, just to give you how cheap rates are today for long-term debt. We priced in a flexible prepayment penalty, and we're at 3.5%. We are doing floating rate loans with the agencies. It's a purchase of private person was buying a property. Originally, he wanted to take a bridge loan, but the bridge loan market seemed to have fallen out, and we got him a flexible floating rate loan at 275 over LIBOR. And if anybody looked at LIBOR today, it's about 13 basis points. So the borrower is going to have a start rate of under 3%.
Wow.
It's structured as a 10-year loan with 4 years interest only. And the nice part about those floating rate deals is that they are giving us 80% leverage, and this is a $20 million deal, just to give you the understanding of what the deal is. it's locked out for 1 year, and then afterwards there's a 1% prepay. So we can get into that if sort of you want to hear a little bit more about how aggressive the actual financing is. I wanted to keep the course to sort of just give the audience just sort of an understanding as to the variety of alternative options, if there's an alternative options as well. And, that brings us up over here to these credit unions, the CMBS. If most people are familiar, they're the old Wall Street lenders that securitize loans. Deals have really not been financed through CMBS unless they were either properties that contained a portion of commercial or retail. But today they're coming back into the market because they're an alternative in certain circumstances where the agencies don't want to finance. We found them, for example, student housing has been looked poorly on right now on the agency side due to the fact that every college in the United States is closed and there's no actually students in any beds, even if they are actually paying their rents. So although they're a great asset and, this COVID will pass and they'll all be back to school hopefully in September, they're really not lending on that. And the CMBS markets have the ability, but their rates, are between 375 and 425. They require greater debt yields, which means the percentage of loan amount that they would give you, compared to the amount of NOI you have is between 8 and 9%, but they are fully non-recourse and they have some nuances to do deals that others may not, and the last really, quadrant over here is really the bridge lending platform. And the bridge lending platform was sort of a great way to finance deals that had value add. And this is how we did a tremendous amount of business when people were purchasing deals that had value add. We were putting in an additional to the purchase price capital improvements. Bridge lenders would capitalize those deals at 80% of total cost with cheap floating rate deals, 2 to 3 years, and, with minimum amount of fees associated. That world dried up very quickly. Most of those lenders were based on
overnight once COVID hit.
They were based on private lines of credit that they had from, a variety of institutions. And the minute this came about, they cut those lines and all of a sudden now they were out of business. So, it's and part of it has to do with the fact that, the business has to be proven out again that it's, to go into a property today, that's the $600-700 rents, and you're going to assume you're going to get to $1,000. Right now, let's assume we have to first get back to levels of 1 where we were, and then we can start improving the properties. No one is really aggressive enough to believe that people's business plans are going to be able to be taken out to its fullest, knowing that we have to first see, where this goes. And, God forbid, there's a resurgence of this is obviously something which everybody has in their back of the mind. No one's convinced without a cure, without a vaccine, that this is the last we're going to see of this. So they're skeptical. That being said, lenders, there is a small group of lenders that are still lending in this platform. Rates are definitely higher, 450 to 500 over LIBOR with a 1% LIBOR floor. So you have to assume you're looking at a 6% to 6.5% assumption on where rates are. But there is a small bucket of cash available for those deals, for the right deals. And, depending on who the sponsorship is and what type of liquidity they have and net worth, and what type of business plan that they can bring to the table, those deals could get done. But like I mentioned, it's a much smaller spectrum of field that we can go out, to get done. So,
And to piggyback off of what Barry was saying, there was one bridge lender that I was talking to last week where his thought on the market was he wasn't going to underwrite to any rent bumps over the next 24 months. So just taking the time to prove out the concept again that you'll be able to, improve these properties and get them to the levels that the deals are going to make sense on an exiting level is going to be something that's important for a lot of these bridge lenders.
And our fifth slide here is really the FHA and HUD. Now, I don't know how much familiar anybody is with the FHA and the HUD, but, the government had one special box, which they created. FHA, Federal Housing Authority, had created. Really, was primarily targeting low-income housing. That was really what the original benefit was, but they opened it up to the typical multifamily. The product is basically a 35-year fixed-rate loan, okay? Now, generally, people that are in syndication or in investors, don't necessarily want to hold the properties for 35 years. You want to be able to work a property, hold it for a certain amount of time, appreciate it, either sell, refinance, move on. But family offices or large families or large REITs that have long-term properties in their portfolios or it's newer assets, and they just want to hold it for a long period of time. This is probably the cheapest rate that probably exists, and it's probably in the cheapest stage where it is right now as it's ever been. And people are turning to this because there's many benefits to the HUD, but there are, many issues that people need to understand how it works, and it may not be suitable for everybody. So, left it towards the end of the slide here, because it is something which a lot of people are talking about. And I just wanted to run through the pluses and minuses of it. Okay. Pluses of it is that rates can be as low as 2.6%. Okay? Just imagine 2.6% rate for 35 years. I mean, that deal is going to have so much cash flow. It's a 35-year amortization. So once you lock that rate, you virtually will never have to worry about refinancing that deal, again. It's underwritten to a 118 debt service coverage. So if you take a 35-year amortization at a 260 rate and a 118 debt service coverage, that deal probably cash flows for 20 to 30% more than you can get anywhere on any agency, any bank deal. So your proceeds automatically on a HUD deal is going to be tremendously higher. They allow 80% cash out refinances, and they allow up to 85% on purchases. Okay. The drawbacks is that it takes about 6 months to close. So typically it doesn't really work for an acquisition unless buyers are giving you a tremendous amount of time in order to get to the closing table. The fees are higher. HUD requires a 30 basis points HUD application fee plus processing fee, plus there's an origination fee. They have a higher reserve schedule generally. They're looking at these loans to be 35 years and to stabilize for 35 years. So you probably has to last for 35 years. So, even if you have a property that is 20 years old and you think it's in decent condition, but by the time the 35 years is up, it's going to be 55 years old. It's going to, by that time, need all new roofs and major appliances and major upgrades to the property. HUD requires those higher reserves to be collected. Additional, they only allow borrowers to take distributions on a biannual basis twice a year with biannual audited statements. So you need to audit your statements with a certified accountant, file them with HUD. They review them, and they allow you to distribute your money. And then every 2-3 years, you need to have a REAC inspection, which is basically HUD comes down and checks literally every light bulb and every outlet that you may have to make sure they're in good working condition. So as you can tell, a person that has a deal, either it's low income or it's a newer property and it's a long-term hold, it's worthwhile to go through some of the nuances of what the HUD requires for a 260 rate, a 35-year amortization, and a maximum cash out at 80%. For most of us, it's a good option to look at, but I'm not necessarily convinced that everybody's sort of going to be happy with it. Like I mentioned, typically people want to get out of those loans. Now, there is flexible prepayment penalties associated that you could get involved in. There are some ways to structure it where it could make sense. If you can, handle out at 6 months, to get that deal closed, and you have the time, it could be something to look at. But it's highly talked about right now because it's the cheapest in the industry, and 80% cash out refinances doesn't exist. Like I mentioned, most lenders want to be at 70% on cash out refinances. So if a deal is coming to an end of maturity or it needs to be refinanced so the investors get back their cash, the only way to get there, especially if they're afraid, cap rates are going to start moving higher and values will start coming down. And 80%, this may just be the only way to really get maximum cash out. But knowing that you must go through sort of the details, and anybody that sort of needs more detail on this, we can send out a brochure as well, detailing, everything that's consistent of this. I didn't want to bog up the program on this particular, what's it called. So this pretty much sums up the, our overall presentation here. I hope you guys sort of get enough out of this to recognize that, the market is open and ready to take on new deals. The agencies are competing heavily on cheap interest rates, like I mentioned a few. You need to be a better person to understand how to structure loans in today's environment. Okay, And it's important for everybody to sort of reach out on deals that they're working on to make sure that they're being properly underwritten properly. Assumptions are noted. Brokers' responsibility now to talk to appraisers before they sign up deals and make sure that they're in good hands, and make sure just the agencies get the ability to really compete to one another, so that we're not just going out to one shop just for the assumption that this is the best deal out there in the market. The better people are going to persevere and stay on and consistently give you updates and recognize where the market's going to be going. And then there's going to be a lot of fallout in our world. We've seen particularly a number of shops, it become big busts of people leaving shops, moving over to different platforms. And Meridian's reputation of being in the industry for the last 30 years has proven us that we can handle through markets, we can stick to the end of the deal, and hopefully successfully. Some of you can reach out to us just individually, and we obviously are happy to give more information on any particular thing. So, Kavitha, that sort of ends my presentation. Mordy, if you have anything else you want to add, feel free to do so.
Yeah, no, I think you pretty much covered it all. I do see, Kavitha, if we want to get to Q&A, I do see there were a few people that dropped some questions in there.
Yeah, thank you, Barry, for sharing that. And we'll go through the questions now. So Raul says, just making the jump from residential to commercial, is all this emphasized more for smaller deals under 1 million, as vacancy risk or general risk to not be able to cover debt is higher?
Mordy, you want to take it away?
Yeah, so I think Freddie SBL, they are underwriting things a little bit more stringently. They are looking at things a little tighter. So in general, yes, when you're looking at those smaller $1 million deals, there's less, there's less room for error as a whole, because of, just you're working with less unit amounts, obviously, and your margin for error is just a little bit shrunk. So yes, they will consider that in the grand picture.
Great. Devin asks, does the agency still give loan to first-time multifamily investors? What are the requirements post-COVID?
Yeah, so Barry, you want to talk about first-time borrowers for agencies post-COVID?
Listen, I don't think there's any issue with a first-time buyer. Maybe he's better off. He doesn't have any issues on forbearance or any of the properties that may have been given back. But first-time homeowners really need to recognize that experience in today's market is going to be more difficult. And if you walked in as a first-time buyer and you partnered it up with a large management company that's going to manage your property, that has years of experience in a particular location, recognizes where the market is, I think there's a way to present the person, as long as he meets the net worth and and the liquidity requirements to go into a deal. So you may be the sponsor, but if you give the challenges in the day-to-day activity to someone that has the experience, they'll take it. If a person comes in and says, I want to try to figure this all out myself, that may be a problem.
Yeah, and we've helped many first-time borrowers buy their first buildings, and thank God it wasn't their last.
All right. Next question with Nathan. Nathan asks, for Fannie and Freddie, what kind of flexibility exists regarding net worth? That is, if you have a high income job, does that factor in somehow if you don't have the net worth to equal your loan amount? Can you explain the process of how the deal versus the borrower is vetted?
They have a certain box. And Fannie and Freddie have differences of how they perceive that. The general rule is you need a net worth equal to the loan amount with 10% liquidity. We've gotten in certain deals waived based on, size and structure and credibility on that end. I don't know if someone can do a $2 million deal today and not have at least a $2 million net worth and $200,000 of cash. And if he was doing a $30 million deal, he may not necessarily need $30 million, with $3 million in cash, but there's sort of a size versus, where the deal is and how that deal can get structured. At the end of the day, most people that are signing up, new buyers in the markets are syndicating deals bringing in alternative KPs to sign alongside them. Yes, it does hurt that you got to give away a piece of the deal to a sponsor that fits the net worth and liquidity, but it's worth the long-term effect of being able to get yourself, first of all, on board with the agencies. They know who you are for the second deal. They'll look at you more, better if that's the case once you sign as a KP. So, there's a tremendous amount of groups that we do business with where we add 6 or 7 people to a KP positions just so they can sign on deals. So they have the ability to go out there on future deals and be noted already by the industry. Once you're already noted, then there can be more flexibility on net worth and liquidity. If it's just your first time coming to a deal and you don't have the net worth and liquidity, it's going to be a lot more difficult to get those deals done. So I don't have there's no magic in that end. I would love to be able to say anybody can be qualified for a loan. But, if we can help you out and if we need to put you in touch with sponsors, then maybe be able to help you sign alongside you, more than welcome to reach out and we can try.
Or Nathan, you could probably be a KP on a deal and get that experience and then set up your own
Correct.
deal as well.
Exactly.
So Jesse asked, do you think there are bridge lenders lending in Houston?
So bridge lending as a whole, as we mentioned, dried up completely. Now they're starting to come back into the market, but they are being selective about deals. Barry, have you seen anything specifically Houston bridge? I haven't specifically seen anything.
Nothing. Yeah, I think the bridge. Again, Houston's an interesting market. There's areas that are heavily on energy, and there's outskirts of the markets which have nothing to do with the energy. So, and I'll say it depends on where the market, where the property is located, what the issues that the property had, why is it need a bridge lender, why is the property either it's if the occupancy is low, what's the reason for it? You have to bake a better story than just say, hey, I want to buy a deal at 75% occupancy and it's been consistent like that for the last 10 years, but I'm going to come in there and do a better job than the previous guy. So there's certainly been more, if a guy has a good business plan and he's executed similar to this in the past, I think that Houston, I personally am a big, I like Houston. I'm bullish on Houston. I think Houston has a lot of potential. But like I said, it's dependent on where the property is located and what the story is.
Yeah, he says North Houston. All right.
North Houston. Okay.
Yeah, North Houston tends to be better than South Houston, in my opinion. I'm not sure how the lenders view it. So another question is, are partially low-income housing eligible for FHA?
So yeah, they're looking for low-income housing as well as they're looking for affordable housing as well as regular free market rents. The answer, in short, is yes. FHA, again, we ran through the whole list of their benefits and drawbacks, but I think as a whole, it's definitely something that can be considered if your deal is right for it and if you're right for HUD, which is
certainly partial low-income housing certainly fits the box. Like I mentioned, that you've been doing regular multifamily today. Yeah. So partial low-income housing certainly will be okay.
So I think this is a related question. Do you have an advantage with Section 8 tenants going into a HUD loan?
I think you have an advantage with Section 8 tenants in general right now because there's almost a guarantee payment that the money is going to come from governments. So the answer is yes. HUD very much looks favorably on low-income housing, HUD loans, any restrictions. But I would say in general right now, if a person can buy a good HUD loan right now, you almost guarantee 90% of your income coming in and staying strong. So it's an interesting aspect of real estate, which, we don't expect to be really impacted by COVID. As a matter of fact, lenders that took reserves on properties, deals that have a majority of HUD or Section 8 tenants that are coming in are more flexible on reserves.
Mm-hmm. Okay. I think she is asking, do you offer HELOC? I guess commercial line of credit? I don't know what Gail is asking.
A home equity line of credit, yeah.
I've
never personally done that. That's more going to be your broker that's going to do your house as well. In terms of, I see she had one other question, Kavitha, before. Do you have to hold it? I'm assuming she's talking about FHA.
Yes.
And the answer to that is there are flexible prepayment penalty options. It's a step down prepayment penalty of 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. So you don't necessarily have to hold it for longer, but it is beneficial because you are putting a lot of money up front. So, you know, if this is a deal that you plan on holding for 2 years, it might not make sense for you. So, you know, if you are a long-term borrower, this is probably going to be a deal that might make a lot more sense for you.
But HUD financing can also be very attractive for assumptions, right? That's how I see a lot of HUD financing goes, is like, hey, you don't really want to place the financing because it takes 6 months to get it through. But if you're doing an assumption, then you get this really super attractive rates on HUD.
Yeah, that's correct.
Sure.
That's definitely correct. And it's for an individual deal by deal basis.
Yeah.
So,
and if you assume a HUD loan, you know, 2 years in, you still have 33 years left, amortizing at a really strong rate, it definitely can be
I'll take
an
that
attractive option.
Right. I mean, you don't necessarily have to hold it. You can refinance. I mean, you can
You can
sell
cash
it
out.
as an
Correct.
assumption. Yeah. Okay, I think those are all the questions. Does anyone have any other questions? Going once, twice. All right. Thank you so much again.
Listen, I appreciate it. Thank you, Kavitha. Thank you for, you know, allowing us on the show. Mordy's going to circulate the PDF for you of the presentation that you can circulate with our contact information as well. And like I mentioned, interesting times. Keep your eye out for good deals. Feel free to reach out to us on any questions that you may have. And you know, let's make 2020 sort of you know, a better year than it is at the moment.
The tale of 2 years. That's what it's going to be.
Tale of 2 years, exactly.
Yeah.
And I'm looking forward to connecting with everybody on the side. Like Barry said, would love to have personal conversations and get to know everybody a little bit better personally.
Yeah.
Thank you, Kavitha.
Thank you. I just want to say, Mordy, you've been super helpful to me. Like, I always reach out to you and so responsive. And I think Tamara is saying she's looking for bridge financing in Michigan. So let's circulate the deck so they have your contact information after this. So thank you again for coming on, Barry and Mordy, and discussing this. I learned a lot from this as well, and I hope the audience learned as well. Have a great rest of your evening, everyone, and thank you all for joining today.
Excellent.
Thank you.
Thank
See you
you.
in 2 weeks for our senior living webinar. Have a good evening.
Good evening.
Bye now.